This is the Euro 50, S&P 500. So this is 50 really big companies compared to 500 companies. So it's not quite the same thing. Dow Jones would be a better one to put against this probably. Notice August. You'll see a theme, okay? So, you got that? Not so long ago, 0 was the lowest possible rate. In Europe right now, and actually at the end of the year, all the red was negative. So we've got countries, duration. So you could get a 10-year Swiss bond that you would give them $1,001, and 10 years from now, they'll give you $1,000 back. Negative interest, right? Germany, Finland, look at all these countries. Negative for some portion. So they're trying to get money out, they're trying to spur growth. Get money out of there, quit putting money on the side. We're not going to give you anything for this. Trying to get it going, trying to get inflation happening, trying to stabilize currency. The upshot of that is if you have fixed income, safe fixed income in Europe, you are guaranteed to make nothing, right? Not that in the US you made a lot, but you're guaranteed to make nothing. I mean, fixed income market is very difficult. So then we add emerging markets. We see emerging markets, emerging markets went up. They started going down earlier, but still that August time frame. Okay, why? 3 quick things. Trade, right? So trade growth among emerging market partners, specifically focused on that second one, the commodity piece. And we'll look at this really specifically in a second, but Russia and Brazil are 2 of the largest emerging market economies. They're both oil exporters. So they are hammered. They're having a very, very difficult time, okay? For those countries that are pegged to the dollar's up in value, they have a very difficult time exporting, just like we do, right? So any country that has and many of the emerging countries do, have a currency pegged to the dollar, they're having a difficult time with their trading partners. Their trading partners who aren't pegged, their currencies are devaluing, making their goods cheaper globally, which makes it difficult for us to compete, also makes it difficult for all of those other countries to compete in the emerging markets. So that's what you're seeing going on in the emerging world. Now, the result of that, so we've done the reverse of this, but the result of that is a net $540 billion of the investments outflow. This is in emerging market mutual funds and ETFs and closed-end funds. This is people fleeing the emerging markets. And you see this one, this is Ben Inker from GMO. He's actually explaining here, this is people are fleeing because it's not a 1-year problem. It's not a 2-year problem. This is half a decade of emerging markets underperforming. And so people are like throwing up their arms. We're not doing this. We're not doing this anymore. So just a little bit of history. 2008, 2009, we were out of emerging markets. 2010, we started entering emerging markets again. And we've continued to slowly build up our position in emerging markets, which means 2 things. It's continued to slide, and we've continued to rebalance into it, and then we've continued to add new money to it as it's continued to slide. And probably here in the next month, we're looking for another buy point. We're looking for another opportunity to add more money to the thing that's sliding the most. Why? We're buying low. Now, it doesn't mean it's going to go up tomorrow. I mean, I've been doing it for 3 years in anticipation. It's still, they say buy when there's blood in the streets, and that's what it's like in the emerging markets right now. Everyone else is leaving, and the value per unit, the value of earnings, the price per unit of earnings is cheap. So that's where we go. That's what we seek out. So then we throw China in here, okay? And you can see China did this. They did like 100% increase from back here, right? 100% increase, a massive collapse, and then it kind of just dribbled along the rest of the year. So something to realize about China, we talked about this about the halftime report, is China has 2 markets. Well, they've got the A market and they've got the H market. Is that right? H? I think it's the A and the H market. So one market is the wild, wild west. It's folks with brokerage accounts day trading in China. And no joke, it's day trading on margin, leverage to the hilt in China. The other market is what our portfolio managers buy or what ETFs buy. Can one affect the other? Absolutely. There's no question about it. There can be bleed over across there. But this was not our experience. That's not the market. That's the market that you see reported on constantly. China is up 80%, down 50%. That's not the reality of the investments that we have. And because it's such a small part of our portfolio, we have an emerging market portfolio, not a China portfolio. So It's still a big part of emerging markets, but it's not the emerging market.